Are taxes about to become a nightmare?
Well, Brent, I got to be honest with you. I am of the opinion taxes have kind of always been a nightmare. You know what I mean?
When I read the title, I was like,
is it going to become a nightmare?
I don't think anybody, I go back to my childhood. I remember my father packing up the shoebox full of tax documents, going to my Uncle Joe's house.
And he's the one that
and
did the taxes.
And they would do the taxes. They'd spend all night probably drinking a little cold beer and then doing the taxes. And I just remember it was a nightmare every year.
Yep,
To hear, but here's what we're trying to cover. And look, I want to put a disclaimer. You guys know, this is the Money Guy Show. We're all about you coming here, learning, applying, growing your success. There is so much just controversy, conflict out there because things are political.
Yep.
We stay the heck away from
That's
that
right.
stuff. You don't come here for political commentary. You come here to figure out how you can grow your army of dollar bills and build wealth. So, but every now and then, the tax code just veers right into our content, and we have to kind of let you know what's going on so you know how to make the right decisions with your finances.
And one thing that we like to do is generally speaking, we tend to try to have a best practice, and we like to not speak on a topic until it's certain that topic will come to fruition. So we try not to like guess and postulate on what things might change because we don't think that's valuable for you to get you all up in a tizzy and freaked out. However, you have been writing us, you've been commenting on our YouTubes, you've been sending us messages saying, hey, I would just love to know a little bit more about what does this mean? What are these things? And so there are some tax topics that have kind of been like headline news. And even though they have not come to fruition yet, we want to kind of lay out for you what they are and what the implications could be if there were changes there.
So if taxes are going to go up, how's that going to impact you?
Exactly.
And what are the ways that taxes go up? Because there's really 4 that have been outlined. So we wanted to kind of jump into each one of these and give you a little overview.
Yep. So the very first one is there has been some talk around marginal tax rates. And anytime we have like new vocabulary on the Money Guy Show, we want to just kind of give you a definition. And when we say marginal tax rate, it's just the tax rate that you pay on your very next dollar of income, right?
No. This is not the way we did it in show prep. Bo, what's a marginal tax rate?
Well, Brian, a marginal tax rate is the tax that you pay on each additional dollar of income.
It's the tax that you pay for every next dollar that you earn. In this country, we operate on a progressive tax system. So the rates start at 1% and they sort of tier up as you move through the tiers. Well, the marginal rate is simply the bracket or the bucket or the rate that your income presently puts you in for your next dollar of income.
So currently, just in case you didn't know, the lowest tax bracket is 10%. And 10% maxes out to the highest based upon where your income is. Currently is 37%.
37%, that's right.
So, but I asked Daniel, I said, Daniel, let's throw up some history of what have tax rates looked like, marginal tax rates over time.
Sure.
And this is what he shows. You know, what I like about what Daniel created here is we've got the marginal rate, which is the highest, meaning what your next dollar of ordinary income will be taxed at. And then we've got actually the lowest tax rates on there. And you, just as I already shared, 10% is currently the lowest. 37, we dropped down from 39.6 when the legislation passed in 2017.
Right.
So the new talk, here's what's kind of coming out from President Biden and the administration on what they're proposing, is that they're saying, hey, we want to take the marginal tax rate back up to 39.6.
So for the highest income tax bracket, instead of that highest being 37, we're going to revert back to the old number, 39.6. Was that surprising to you that was a thought?
No, I kind of think a lot of people thought this was probably going to be the easiest, lowest lying fruit if they are going to raise taxes. Now, here's the thing I think you should watch if you want to kind of start, reading the tea leaves. The administration has shared that what they're trying to do is anybody who makes under $400,000 will not be targeted, but anybody who makes over $400,000, fair game on raising income taxes.
Sure.
Well, right now, $400,000 is right around the income where married filers pay 35%. So my question is it only going to be the 37% that goes back up to 39.6, or are they actually going to bring it down to where we also lose a portion or all of the 35% tax bracket as well. That is something just kind of to be on the watch for.
And we don't know the answer yet. Obviously, none of this legislation has come to pass, but it's something that we want to make sure that we stay aware of. So the practical implications of this are, if you are someone who is in one of the higher tax brackets, and you have the ability to maneuver your income, whether you accept bonuses in this present year or you push into the future year, as we begin to have some clarity around what those top tax brackets will be, you may want to start thinking about, okay, in what years does it make sense for me to recognize those types of incomes?
Yeah, and this is so if you're a person, you're trying to figure out Roth versus before tax contributions in your retirement plan and so forth, this is going to push you more towards deferring taxes currently so that you hopefully when you retire are in a lower tax bracket.
Perfect.
So let's move on to the next question. Bo, what's a capital gains tax?
Well, Brian, capital gains is a tax on the growth and value of investments incurred when the investments are sold. Essentially, if you have an asset that you've bought and it goes up in value, an investment that you've bought and it goes up in value, and it was a capital investment, it was an investment that you made, the increase that you make on that, you pay a different tax rate on than your ordinary income tax rate. You pay a capital gains tax on that profit.
Now, this one was actually kind of surprising to me because, look, the government, if you guys, I've talked about this several times because remember, I have a background, CPA, 16 years of tax preparation experience. I feel like I've kind of been in the trenches of understanding the tax game. And I've talked on a lot of shows about how tax policy in a lot of ways is either a stick or a carrot.
Okay.
They're either trying
What
to
do you mean by
punish
that,
you.
either a
Well,
stick
yeah, the stick is you're being punished for certain behaviors. A carrot is they give incentives for other behaviors. And let me give you an example on both. Like the stick approach, think about this now. It's not an income tax, but it's just a tax policy. If you look at your local municipalities and state governments, what do they typically do? They charge taxes on cigarettes. They charge tax on alcohol. You know, there's all kind of things like that. Those are sin taxes. So that's not uncommon. And then you think about what's the carrot approach. Well, the carrot approach is think about charitable contributions. They give you a tax deduction on that. If you buy a house, they give you a tax deduction. In the past, they've even given tax credits. Education, there's tax credits because these are all things that we have written in are good. So capital gains, as the definition explained, this is tax on investments. Now, realize this is not money that you put into a retirement plan because those grow tax deferred. Everything that goes into investments that qualify for capital gains tax are after tax contributions, meaning they've already been taxed once. So the reasoning was, hey, let's encourage investing, and then we'll tax it at a lower rate to encourage this behavior.
And so one of the things, a lot of people will get kind of confused, or they might think, okay, well, capital gains, you're talking about like when I invest in a brokerage account that's not a retirement account. That is certainly an example, but it's also a lot of times when businesses are sold, small businesses are sold, they pay a capital gains on the growth in that business. Or if you sell rental properties or real estate, those are often, if they're not primary residences, those are taxed at capital gains as well.
So Daniel once again put together another historical capital gains rate analysis. This is since 1954, what is the highest rate that we have here in the United States? And you can see it's bounced around, but the highest it's ever been was back during the Carter administration. It was
70s.
Right around 40%. But then it's been really much lower than that ever since. We were at 25% with tax updates went down to 20, and then higher income people pay a Medicare surcharge that was passed when we did the Obamacare. Well, it was Obamacare, which was the Affordable Care Act. So that actually added that 3.8 on higher income people. So what is now being proposed by the administration is anybody who makes over $1 million of income, that this will go up to 43.8%. So you can quickly see that this will actually drive the capital gains rate to the highest ever in history here in the United States.
So there's sort of two practical implications that we think. One, if you're someone out there who's thinking, oh my goodness, I heard that capital gains rates are going to go up, I'm going to go out today and I'm going to sell everything in my brokerage account to lock in that 15% long-term capital gains rate. remember, at least the way it's looking is this is for folks whose income puts them into a certain threshold where it would trigger that higher capital gains rate. If you're not in a place where your income would be there might not be a lot of proactive planning you ought to be thinking through. However, if you are someone, a small business owner or a high income earner, where this type of transaction could potentially impact you, you may just want to pay attention to what is happening with legislation, and if it's something that's going to change the way capital gains are treated either in 2020 or in 2021. Again, none of us know. And so if you make any big, gravitous life decisions based on speculation, you need to recognize you're taking a big, big risk there, but it is something you can be thinking about.
Yeah, if I was reading the tea leaves on this, I don't think it ends up at 43.8.
Sure.
I think what ends up happening, that's probably just a shot to start the negotiations. It's going to come down moderately from there. I did come in with a joke to Bo, though, because they had written in, I think there's a narrative that whenever you propose stuff like this, you say, well, what about all the small businesses? Mm-hmm. What about the farmland and those type of things? So the administration has tried to be proactive on that, and they said, you know what? We're going to create some exemptions or loopholes for, beneficiaries that are actually family members on the farmland, on the small business. So I came in the next day and I said, Bo, good news, you're going into business with my daughters at some point. So I make jest at it, but it is one of those things. I think this will be something to watch because it impacts a lot of your small business owners, farmers, anybody with real estate. Mm-hmm. Because, look, $1 million is a ton of money. We just did a show on $1 million because it's still a decent chunk, but it's not that hard of a threshold to cross if you've been building a business for 15, 20 years.
So those are two things that we've kind of talked about that are likely to affect higher income earners or folks who have large transactions that push their income up in any given year. This next one, Brian, I think is going to hit more. If it changes, it's going to hit more people than you realize, because this pretty much hits everyone to some extent, or will likely hit everyone to some extent.
Yeah, this one was kind of interesting because what we're talking about here is stepped up in basis.
Oh, another vocabulary word.
Yeah, so we don't have to do that. I'll do it. You do not have to. The Poindexter is starting to grate on me, so we'll let Bo. What's a step up in basis?
So a step up in basis is the readjustment of the value of an appreciated asset for tax purposes upon inheritance. Let me break that down in layman's terms. Generally speaking, if you inherit something from someone, a capital asset or a home or an investment account, what happens is even though they might have large embedded gains in that thing that you inherited, on the day that they pass away, the government says, you know what? That thing, even though they only paid $100 for it, and now it's worth $200, when you inherit it, you get a step up in basis, where your new basis in that holding is whatever it was on whatever the value was on the day that the person died. So all of that capital gain goes away. It just kind of evaporates. So as far as wealth transitioning from one generation to the next, whether it be investment accounts or rental properties or businesses or fill in the blank, step up in basis was a huge way for wealth to pass on without having to recognize all of the capital gain that those assets had achieved over the lifetime of those assets.
Yeah, where we've seen this play out, we're from Georgia now. We, of course, live right now right below Nashville in Tennessee. But in Georgia, everybody has a story of somebody they know that their grandma or great-grandma at this point bought some Coca-Cola stock.
Absolutely.
Or if you depend upon which side of the state you live in, Aflac stock, or Home Depot, for when that came around. And so what happens is that if you have that great-grandma that bought Coca-Cola before it was a household name, it's not uncommon that people have been passing on that stock that grandma bought for a nickel.
Yep.
I'm making up a number,
Sure.
but then when she passed away, all the gains kind of went away as long as she was below the estate tax threshold, which right now is really large. So this could be something that I do think impacts more people, is because a lot of your assets, I mean, you've probably, I see this all the time as people get older. We see this with clients. You're like, ooh, we can do several things here. We can donate to charities, or we can hold on to these highly appreciated securities and just pass them on to the beneficiaries. I think this will actually encourage people. Why save or wait? Let's either go spend it, or let's accelerate passing down the assets to our heirs earlier than we planned.
Now, you said something really interesting, Brian, and one of the benefits I want to give you, a lot of times we're having kind of like side conversations, is you have this ability to kind of step back and see the really big picture. Sometimes I get granularly focused on the small picture. And he said, here's what I think is really interesting if they adjust step up in basis. I think that the unintended consequence is it is going to accelerate something that happens naturally anyways. You want to talk a little bit about
Yeah, because what I talk, you guys, you probably, this is going to be one of those, I'll get a comment where somebody says, if he talks about this again, I'm going to poke myself in the eye. Is that I talk about all the time is that 80% of millionaires are first generation, meaning that it doesn't mean they did it by themselves, but I just want to make the point that they come from limited means, had some breaks, and things have worked out incredibly well. Bo and I both represent that first generation of seven-figure status. That is outstanding. That's to be celebrated. We've talked about how that number has stayed pretty consistent throughout time. Here's the downside of that number. For us to have 80% of millionaires be first generation, that means wealthy people are horrible at staying wealthy and keeping money. And the stats prove that in the fact that 70% of the second generation lose the wealth. By third generation, it's 90% is gone. So there's actually a natural cleansing process of wealth that already exists. That's one of the other things that the Money Guy Show is trying to help, is I think as soon as you can to educate your children on how you steward and manage money well, you'll hopefully just stop that sad process of destroying wealth, destroying assets. But I think this will accelerate the passing of wealth. Instead of people sitting on assets, they'll be like, either I'm going to spend it or I'm going to go ahead and give it to the kids sooner.
So again, this is one of those things. Don't mishear us and say, oh man, Grandma, I know that we were sitting on that brokerage account that had all of those stocks. With
or the house. We see it all the time. Somebody on their deathbed says, I'm going to go give the kids the family house. And you're like, ooh, man, they live in California. They paid $15,000 for that house. It's now worth $1 million. There's could be something that, be careful. Bo was getting to the point that this is not law yet.
This is not law yet. So be careful making decisions and making assumptions of what will become law. Because right now, if someone were to say, hey, I'm getting towards the end of my life and I really want to think about estate planning, should I start putting my kids' names on title? Should I start gifting assets? Should I start getting stuff out of my estate? And my answer would be, if you are worth less than $11 million for an individual person or $22 million for a married couple, I still think it is the most advantageous from a tax perspective for your beneficiaries to inherit those assets as opposed to you giving them those assets. So just know this is rumor out there that could change, but it has not changed and is not certain that it will change.
Yeah, proposed. Rumor sounds like, Mabel passed it down the street to no, this is
How many neighbors do you have named Mabel?
Well, I'm just, I watch a lot of TV. But I do think it's something that is proposed and we need to wait. That's why I always get nervous about covering things that are potential, but this is important stuff. And that leads to the last thing that's been pitched out there, and this is corporate income tax reform.
Yeah, so one of the things that we've already covered that when we earn income, we pay our marginal tax rate on our ordinary income. And then when we invest our income into assets, we pay capital gains on the value of those assets increasing. Well, corporations also have a tax rate. When businesses make money, they also are required to pay taxes at a certain rate, and there's some talks about that rate changing. So corporate income taxes are just levied by federal and state governments on the profits or the earnings of a business.
Yeah, so this is one, I think this is interesting because we all know under the 2017 tax reform that went into effect in 2018, corporate income tax rates dropped all the way down to 21%. Now, here's what that did. Is that made us one of the lower tax rates of a developed country in the world. And the whole purpose of this is that a lot of our corporations, because here, realize a lot of American corporations, their business is not just here in America. I'll go back to my Coca-Cola example.
If you've ever traveled internationally, you've seen this.
You see, it's not uncommon to see a McDonald's, in another part of the world. You'll see Coca-Cola. So the status, somewhere around 30 to 40% of like the S&P 500 comes from global operations. So what the tendency is when you start getting into tax rates by country is big multinational corporations, they play reindeer games.
Sure.
So the headline that I still remember is, and I'm not picking on them, I'm just telling you what was reported, like Apple and there was quite a few other technology companies had moved a lot of operations, or on paper had put themselves in Ireland because the tax rates in Ireland were
so favorable,
substantially lower than they were here in the United States. And that was part of when we were talking about bringing money in, was lower the tax rate. Well, the proposal on the table from the administration is, let's take the 21% tax rate up to 28% for the corporate tax rate. Now, what I think is interesting is that the administration is trying to get out in front of the messaging on this, because they said, yeah, we know that this will, speed up the process of everybody talking about how do we compare to other developed countries. And so the President Biden did something kind of unique. Is he then said he's proposing a corporate tax rate globally. He wanted to go talk to the United Nations and other developed countries, and essentially everybody get together and agree upon where tax rates would be, so we could get away from all these reindeer games. I'm kind of a skeptic on, because I think everybody is, just like individuals are selfish, I think countries are somewhat selfish on where if they see that one country is doing something, if they can create an economic advantage for their country, they're going to probably try to take advantage of it. So I'll be curious to see where the number comes in. I wonder, I think 28 was probably more of a negotiation number thrown out. I really don't see us going to 28, because that would push us up to where I think that a lot of these multinational corporations will start moving operations out of the United States and moving things around. And I don't think anybody wants that, so we'll probably settle in, if it does pass at all, it would settle at a more, middle of the ground rate.
And so I think the big takeaway, right now, obviously there are other changes than just these ones we've kind of thrown out there. The big takeaway is sort of twofold. One, nothing has happened yet. It makes sense to pay attention to it, but I wouldn't start losing sleep over things that have not happened. But with most things, if you're willing to educate yourself and educate yourself well, there are going to be opportunities. There are going to be ways to try to mitigate whatever changes may or may not impact you. I mean, I can see in our live chat right now, people are already talking about ways that they can avoid or adjust, and that's right. One thing that makes me sad, I look at our current tax code, and it just seems awfully complicated to me.
Well, we had a sidebar conversation on this. Is that it seems so simple when you pitch tax policies that we're going to go capture more revenue. A lot of times it doesn't turn out that way, because you pitch more revenue, and it's back to the stick and carrot approach. You incentivize, and then a lot of people, all you do is you really enrich the CPAs, the attorneys, because they get creative on coming up with ways to circumvent this stuff. And then I always think about what I think is wasteful is you get busy doing nothing. And tax planning in a lot of ways is getting busy doing nothing, because does it create innovation? Does it create, the next great thing for a country or a community? And it doesn't, but yet there will be a lot of mental power that will go towards tax policy. And legal, and I'll say it, legal tax avoidance. And that's, Bo, you always make that point. What's the difference between the stuff that gets you put in jail versus maximizing your deductions?
Yeah, in the country in which we live, tax evasion is illegal. It would get you locked up. They will come take your stuff. Tax avoidance, however, highly encouraged. And we have a very large, very complicated tax system written around all the different ways that you can avoid paying taxes. Here is our charge to you guys. As we continue to learn more, as this stuff continues to come out, we're going to keep letting you know what's going on, what's changed, how does that impact you, how can you plan for that. Make sure you control the information coming into your minds. Whatever we say here, make sure you fact check us, because it makes me so sad when I'm talking to neighbors or talking to friends like, hey, heard tax laws just changed, I'm going to go do this. I mean, whoa, no, pump the brakes. Nothing has changed. Don't start making huge decisions because some headline told you that something crazy was going to. Make sure you do your research and understand whatever decisions that you make, especially as it relates to taxes, are in your best interest and make sense for you. And remember, like when it comes to taxes, black is good and white is good. Gray is a little scary because if you try to do something a little too aggressively wrong, they can come take your stuff, and that's once again what gets you put in jail.
I always say everything's deductible until you get caught.
Yep.
That's a little CPA humor there, but it is true in the fact that be careful. You always want to, when you're making deductions, pretend you're sitting across the table from an IRS agent, and do you feel like you're on stable enough ground? That's the point Bo's making. But here's my promise to you guys. as this stuff gets closer to firming up to becoming the new law or whatever changes come your way, we'll keep you posted. We're going to keep you up to date on it. We're going to make sure, like I said, we try to keep the political stuff out of it because remember, money's not red, money's not blue, money is green. And we're going to help you navigate through all of that process. So keep coming back to us as a resource, and we're going to work hard to make sure you know the actionable items for your army of dollars.
All right, so one of the things we like to do here is we are here to serve you guys. We want to make sure that we load you up with tons of information. And so obviously some of you probably had questions on taxes, so we answered those, but you might have other questions. You might be thinking, hey, what do you guys think about this, or how should I approach this? And so we love to answer your questions right here in real time. So if you have a question, make sure that you get it into the live chat. Right now I've got the live chat rolling in front of me. I've got the team dropping questions into a spreadsheet for me. And we're going to just run through them. So let's start with this first one. This first one is from Preston.
Oh, cool name.
Preston Hale. We have a Preston represented here and a Hale represented here. We got two different names. This is what Preston said. What should we invest in to prepare for a correction? And then, this is what Preston, 30 to 50% correction. What should we invest in to prepare for a 30 to 50% correction?
Man, that is such a simple question with a very complex answer. And what I always say, look, when we talk about specific investment advice, we cannot give you specific investment advice because there's so much that comes into play. What's your age? What's your risk profile? What are your goals? When do you think you're going to retire? How much money do you make? All these things kind of come into, and you take all those data points in, and you shoot out the investment plan for a client. Now, so I'll give an answer, though. What should you invest in? It's going to be diversified. I mean, and I know that's kind of like, oh, gosh, I was hoping he would throw out an actual ticker symbol or thing. That's not the way this works. We always tell people, design your plan based upon what you want to do, when you want to do it, and then understand your why, and then we can start moving the pieces around to make sure you have enough risk assets like equities, enough diversifiers that help you against inflation like real estate and other things like that, and then we'll have enough conservative assets between our alternative sleeve as well as even old bonds that are kind of everybody's favorite kicking bag right now, but we'll work through all of that stuff. There's not some magic silver bullet on where you should be. Now, I will tell you, somebody who's in their 20s or 30s, don't overthink this. Even in your 40s, if you're just now starting, I love indexed. I want to make sure I emphasize indexed target retirement funds in the three biggest providers, Charles Schwab, Fidelity Investments, and Vanguard. You just tell how much you can save, when you need the money. They'll do a lot of that guesswork for you, and then you can just let your assets grow in the background, and then you can focus on building success.
All right, hey, Ribby, I'm going to give you something right here. Make sure you take this sound clip because this is going to be super valuable. I'm going to let you guys in on a secret.
Uh-oh.
A huge correction is coming. But we just don't know when. At some point in the future, it might be a year, 2 years, 5 years, 10 years, 20 years, 30 years, 40 years. We know that corrections are happening. The problem that I have with Preston's question is it sounds like he is assuming it's happening soon, right? That we're going to have a big correction that's going to take place. Well, that may or may not be true. It may be surprising for you to find out that when we design portfolios for clients, we base it much less on where that client is right now in this market cycle and more about where that client is in their financial life cycle. Meaning that we want them to have a good portfolio that whether the market goes up 30 to 50% from now or down 30 to 50% from now, they're in a portfolio that makes sense for that. If you're someone out there floating around and your allocation shifts from an 80-20 to a 20-80, I'm going to make the argument that you're doing it wrong. That is just maybe a little bit more aggressive market timing. You should have an allocation that makes sense for where you are, your current account structure, your tax situation, your unique risk tolerance matched with your risk capacity, and what your overall goals are. Nowhere in there did I say you should have a portfolio prepared for the pending downturn or the pending upswing. Yes, it's okay to tweak around the edges, but what you should invest in to prepare for a correction is the same thing that you should be investing in to prepare for the bull market, because none of us know when either of those are going to happen.
Well, even if you think things are getting frothy out there, guys, it can run for another 2 to 3 years.
Yep,
I mean, that's the
absolutely.
part. That's the problem with timing. You can, and Bo and I have done this with investment tactics when we were right on our prediction, but we got the timing all wrong.
Yep.
And so if you're looking at the economy and you go, man, things are really frothy right now, I'm going to get on the sidelines and just wait for the correction point and then get right back in. 2 years might go by and
That's
you're going to
exactly
kick
right.
yourself. And remember, this whole concept, I always like to blow it out to that 30,000-foot overview. You are walking up a mountain with a yo-yo, and the fact that, yes, we're always worried about that 2 out of every 10 years correction, bear market, downturn, but it is always going to higher and higher ground. And you're like, yeah, but we're in a new paradigm. I got an email on Twitter. I mean, email on Twitter. I got a comment on Twitter asking me what happens when the U.S. goes away, China takes over, and what should we do? And I said, this sounds a lot like a new paradigm question. And always,
exactly
whenever
right.
you get questions that we're in a new paradigm, my spidey senses say, woo, be careful because you're probably getting yourself worked up into a change. And I don't even know what you do. When people ask me those one-off questions of what if this is the worst thing that we've ever seen, I'm like, how do you even create a plan for like the collapse of an economy? If you play this out to what you're doing, there's not a plan there other than, and as I said on Twitter, going and watching the movie Red Dawn, and then trying to figure out who in your community you can become friends with that actually has a sporting goods store right down the street that you can go raid as this all happens. That's about the best
That's about as
preparation
good as
you can do.
That's it.
You know, so otherwise, I think creating a good diversified investment plan that serves your goals, your age, and your desires will be what you need to do for your army of dollars.
Love it. That was a great question, Preston. Thank you. Here's the next one, Brian. This one is a tax one that I think you're going to like. This is from Jason. Jason said, can I go back to my 2019 and 2020 state taxes and claim a deduction for my child's 529 that I didn't know I could claim? My state allows me to claim a deduction on any state's 529. So here's the question he's asking. And oftentimes, whenever we have a brand new client come on board here to Bound, one of the very first things that we do is we request a copy of your most recent tax return. Well, it's not uncommon that as we're reviewing that tax return, we say, hey, this tax return, you mentioned to me that you did this thing, but I didn't see it on here. Or you told me you did a Roth conversion, but this is showing that it's taxable. Is our answer to them, whew, but you should have hired us last year, you're out of luck? Or are there things we can do if we uncover things in our tax returns that we did not do in the past?
Yeah, this is an easy one. You can amend for 3 years. And now, look, every state's a little different on the way they write their tax policies, but federally and for most states, it's 3 years. So if you find a mistake, you can go back and grab that money, or if you find that you've made a mistake, you can go and refile the taxes to correct it. Now, I do want to caution, because I saw this happen recently, and I want to throw this out there, a little free tax advice. When you get a notice from the IRS about a mistake you've made on a tax return or something missed, first of all, don't just pay whatever they tell you on the notice, because I got to tell you, in all my years of doing tax preparation, I would say the lion's share of those notices were just for clarifying points that they needed additional documentation. But if you just read the notice and said, man, the government's saying I owe $6,000 more, I guess I'll have to write a $6,000 check. No, that's a mistake. Go and work through it and make sure it's truly, because they might just need a clarifier. But we had somebody who came to us that there was a thing that needed to be clarified, and instead of just writing a letter to the IRS explaining what the clarifier was, they actually filed an amended return after they got the notice. That actually slows the process down. It confuses the IRS because they already have caught that there's something askew here. If you immediately run out and then file an amended return, their left hand doesn't know what's going on with the right. So I always recommend be very careful when you get the notice. First, don't just pay it. Go see what's going on. But then you probably want to respond directly to the notice and not file an amended tax return. That's just it's a freebie, just as something we saw recently, and I figured I'd share it with the audience.
If I am someone who recognizes there was a mistake or something I missed, should I take it on my own to file an amended tax return? Or if I have to file an amendment, is that when it makes sense to go see a professional tax preparer? Like, is it an easy process to file an amended return, or is it more complicated?
It depends upon what you use. Now, if you hand wrote this, I mean, because the 1040X is not actually a complicated form, because all
That's
it does.
the form you have to file to amend
Yeah,
the tax
that's the
return.
amended return form, and basically you're going to show as filed, you're going to show the change, and then you're going to write up some narrative for what actually changed with supporting documentation. But a lot of the like TurboTax and other self-preparing softwares make it actually pretty easy. But if you paid a professional, they're going to be able to help you out too. I mean, we had a client recently that we reviewed the tax return. Unfortunately, the charitable contributions, because they were doing a charitable gift fund at one of the investment firms, the 8283 didn't make it on the tax return, so we had to amend it. Usually, most tax preparers will charge you $150, $200 to amend the tax return. That stinks. Nobody likes paying additional fees, but it's definitely going to be worth it if you missed a very big tax deduction.
Yep, love it. This next question is from Robbie. Robbie says, if my employer offers a Roth 401k option, should I even consider a backdoor Roth? Now, when he says backdoor Roth, he's talking about funding a traditional IRA and then converting the traditional assets to Roth assets. And if so, does a backdoor Roth make sense if my spouse has an IRA? So I think he's really asking two questions right here. One, are there times when I should do a Roth 401k versus a Roth IRA or backdoor Roth IRA? And then two, are there things I need to think about with my spouse's assets, like if she has other types of accounts? The first thing that I notice when I kind of think through Robbie's question is if he's having to do a backdoor Roth, that immediately suggests that his income is too high to be able to do a direct Roth contribution. And he said he's married, so this is a household that's making about over $200,000 of annual income. My argument there would be, depending on what state you live in, but even just federally, you're in a tax bracket where, man, that current year pre-tax deduction is pretty stinking valuable. And if you look at how much you contribute, whether it's $19,500 if you max out or $26,000 if you max out, and you calculate your tax savings from doing that pre-tax, there's a chance that the tax savings from you doing pre-tax 401k contributions might be great enough for you to fund the backdoor Roth, right? That might actually give you a mechanism where you could do that. That's the first thing that kind of stuck out to me immediately.
Yeah, and then I'll add in the fact that I think it is interesting when you talk about married couples is that fortunately, the government looks at each of you as individual IRA contributors. Even though you're filing a joint tax return, in a lot of cases, majority of cases, you're filing a joint tax return. The government's going to treat you as individual IRA holders. So you're right. You do need to always be aware, because a backdoor or Roth conversion strategies go require that you don't have IRA rollovers, SEP IRAs, simple IRAs sitting out there, because if you do, any type of contribution you make to those, you're going to have to prorate your total IRA balance, and it really screws up being able to do that Roth conversion strategy. So that's the first thing is like, do you have other IRA assets? Well, now a lot of you guys are like, I don't have any, but my spouse does. So so that probably screws this whole thing up. No. Your spouse probably can't do Roth conversions, but because they have an IRA sitting over here, but you actually can, because the IRS lets you look at yourself, not your spouse. They're separate. That's why if you look at on your tax return, when you make IRA contributions, there's a form 8606 that's going to show your contributions, your basis. You're going to have two of those. If you're a married couple, you're going to look in there and be like 8606, 8606. And you're like, oh, one's for me, one's for my spouse. That's why they keep everything separated, because these are essentially retirement trusts. That's what an IRA kind of is for you. So you need to look at, do I have IRA assets? And then if you don't, you can consider this. But I think Bo is spot on. If you're in a high income tax situation, I love the thought of you getting the current year tax deduction, because hopefully the goal is when you retire, you're in a lower tax rate situation, because you're going to manipulate legally your taxes by all the different buckets of income, of the assets that you have, whether you have after-tax brokerage accounts, tax deferred, which is going to be your matching funds as well as your pre-tax contributions, and then you're going to have also your tax-free or Roth assets. If you structure this right, you'll have the ability to potentially lower your taxes in retirement, do Roth conversions. So I like the thought of you taking the tax deduction now, funding the Roth with that $6,000, $7,000 if you're 50 or older, That's a win-win.
It's a win-win. It's not an either-or. It's a both-and. That was a great question. This next one. So we just talked about how there could be some tax changes, and one of the areas that taxes could change is how capital gains are taxed. And again, the financial mutants that listen to this show already start coming up with strategies, right? And so Nancy, I'm sure that she heard this, and so this is her question. Hey, could one donate appreciated assets to avoid capital gains so a charity gets the benefit and you get the tax deduction? And what she's talking about, we've talked about a ton, charitable giving, using a charitable gift fund. Let's talk a little bit about what that is and why, if capital gains rates do increase, why that might be even more valuable for someone to consider that type of strategy.
Yeah, Nancy's actually cleaning up the work. I'm sitting here, when Bo asks me questions or we're doing shows, I have, there's key points I want to make sure I hit. And then, but it never fails me when I watch a clip or, a show starts performing well and I go follow up to see what it was. I'm like, oh, that was good, but man, I wish we'd added this. Nancy just called in a big one, and the fact that it is true. If all of a sudden capital gains rate, especially for the highest income earners, goes up to 43.4%, people are going to be like, woo, that's a lot of taxes to pay. And if you're charitably minded, you're going to get really excited to think about, if I have these highly appreciated securities, I'm charitably minded, I could donate those securities. And the charitable gift funds that Fidelity and Schwab offer make this so easy, because what happens is you get a full deduction for the fair market value of what that donation was on the day it was made, and then you never, ever pay the income taxes on that appreciation. So it's a win for you because you get a full market value deduction. You never pay the income tax. It's a great deal for the charity because they get the full value. They typically take the assets, they liquidate it, or like Fidelity Charitable or Schwab, they actually get a check. The charity will send it out they'll send it out directly to the charity. It is a great planning opportunity. And then I don't know if I should go this deep with it, Bo, but I give monthly to my church.
I already know where you're going with it. This is your favorite part of the strategy.
I love it because it is one of those things where, forever I gave cash like everybody else. But once you've been saving and investing long enough, you will have a big pot of appreciated holdings. And it hit me a number of years ago. I was like, this is crazy that I'm giving cash away. I ought to be giving these appreciated securities because, like I said, it's a win-win. I'm giving to my church at a much higher appreciated asset, never paying income tax on it. And then here's where you turbocharge this. I dollar cost average. Since I was giving cash to my church every month, what I do is I give appreciated securities, but then I buy back
the exact same thing.
The same holdings, or in an investment. It doesn't have to be the same one, but I just buy investments. What I'm essentially doing over time is I am raising my basis in those appreciated assets, so I have more access to those assets if I ever needed them for liquidity. Plus, I'm essentially replanting seeds. It's kind of like if you know anybody that does timber. What do they do when they go, harvest the pine trees off the land? They immediately come in and plant new pine trees right behind it, and they repeat this process every 20 years.
So you're timbering your taxable account.
You don't have to do this every 20 years. You're going to get a much faster turnover on this, but it is a matter of essentially replanting your growth garden. And what's amazing to me, here's what's cool. Because when I do my Fidelity monthly charitable contribution, it lets me, because I maximize the deduction.
Sure.
So it will actually show me the lot of the securities we're donating. And what's really wild to me is that we know 2020 was just a crazy year. I have securities that I bought in February and March of 2020 that appreciated close to 50%, maybe even over 50%, that have now gone to charities. I didn't pay any income tax on that.
You said something right there that is worth noting. One of the reasons he specifically mentioned February and March of 2020 is that when you do give appreciated securities to a charitable gift fund, it has to be long-term. If it's not long-term, you actually don't get that same benefit. If you give a short-term holding, let's say that you participated in GameStop and you put $1,000 into GameStop and all of a sudden it turned into $5,000. Like, you know what? That was fun. I'm going to donate that to charity. but you only held it for 3 or 4 months, the charitable deduction you get is only equal to your basis, not the actual value of the holding. So you get rid of $5,000 of value and only get a $1,000 tax benefit for that. You have to make sure that the holdings or the lots, if you're doing specific lots like Brian, are long-term. They've passed that 365-day window.
I will say, because I had somebody from Fidelity reached out to me directly and said, hey, loved you. You're talking about charitable giving. But you screwed it up in the fact, because it was originally, it was like $5,000 minimum to open this, then it was $2,500. I think it's zero. That's the correction I got from Fidelity Charitable, is that they're like, we're zero now, so there's no minimum to open up one of these accounts. So I mean, this is, if you are charitably minded and you have appreciated holdings in your taxable account, get to it, because this is a great planning opportunity.
Love it. That's a great question, Nancy. Thank you for that was very on subject today. This next one is from Jay Butters. Should I include my 529 investments on my net worth statement? So you guys know one of the things we love doing is every year, it's like Christmas for us, we love doing our annual net worth statements. It's kind of become something that Brian and I celebrate every year. We talk to you guys about it. Well, we do get questions all the time about, okay, well, what do I include? What do I not include? Jay Butters specifically is asking about 529s, but maybe we should also talk about, well, do I include life insurance on my net worth statement? Do I include Social Security? Do I include pensions?
Yeah.
What things should I not include on my net worth statement, and why should I not include those?
Look, 529s, because they are something, you have a lot of control. You have a lot of flexibility, especially if they are ultimately for the benefit of the beneficiary named on these accounts, but you as the parent or the owner of the account have a lot of ability to move that money around. So with all that said, I still think, and this is the way I do it on my own my own net worth statement, I put it in my footnotes on the net worth statement. I do not put it as my own asset, because remember, it is for the benefit of my children. So I never want my net worth numbers to be skewed by the assets that are being held for someone else's benefit.
Now, I personally consider 529s for my girls to be what I like to call a prepaid future expense. Just some nomenclature that we like to use. Well, if you think about it, a prepaid future expense is kind of money that's already spent. Now, the reason I said that is because prepaid future expense is actually one of the orders of our financial order of operations. 529s is one of those things. Well, in my mind, that's money that's already spent, money that's already gone, and that's the reason that it doesn't hit my net worth statement. I'm just going to throw that in there because I feel the same way.
So you had thrown out a few other kind of footnote or clarifying areas like life insurance. We all know basic financial planning 101. If you have permanent insurance with cash value, you can put the cash value on your net worth statement. Now, I'm going to tell you, the majority of you guys probably just need term life insurance.
Also, if you have life insurance with a cash value permanently, maybe you just want to revisit why you have that insurance. Just a little aside.
That's a sidebar. We've done plenty of videos on that too, and plus it gives a jab to our insurance audience. But it's not that we're trying to, but I feel like it's just misused in a lot of ways. But the other thing is, we hear about Social Security and pensions. And I know there's a lot of military folks that watch too. Look, your pension is very valuable. I think a lot of people mishear me, and they assume when I tell them you shouldn't put this on your net worth statement that I'm totally diminishing
not at all.
the value of the pension, and I'm not. But I do think, like, let's take Social Security before I talk about pensions.
Because Social Security is a pension, really.
Social Security, if you tried to present value its benefit, without a doubt, it's important to your retirement plan. It's got a lot of value to you individually, but it is exactly what Bo talked about. It is a promise of future payments. So to try to put that on your net worth statement is inappropriate, because it's not an actual asset that you could go liquidate and turn into something. Now, look, it is going to make retirement a lot easier for you. You can figure out what your living expenses are, subtract out what that Social Security will be. It helps you out tremendously in the retirement plan, but it is not something that you could, if you needed the money tomorrow, you can't go liquidate your Social Security account and get access to it. So it is a promise of future payments. Let's move towards pensions. Pensions are kind of unique because they're not only promises of future payments. a lot of times pensions also are set up to where there is a cash value or an investment that's been set aside for you, and you have the choice until the day that you actually kind of annuitize it. That some of you can roll this money into a qualified retirement plan, and you get, update statements for what your benefit or value rollover benefit currently is. If you get those type of statements, whatever you're vested, meaning vested that you've already been working long enough to get the full benefit, your vested balance, I think you can put that on your retirement net worth statement. There's nothing wrong with doing that. But if it's something that you're never going to have the option to roll it over, I think it's another footnote because it's a promise based upon your life or even your life and your spouse's, depending upon what you elect on the day that you annuitize it. It's still not an asset. It's going to be tremendously valuable. I mean, for a lot of my military and others school teachers, the actual value of your lifetime is going to be worth millions. But it doesn't mean you get to put $1 million on your net worth statement because it's a promise based upon your life. It's not something you could actually get access to. So it's going to help you tremendously for retirement planning. You can, like I said, figure out your living expenses, subtract out those future cash flows from that promise. But I don't think it's appropriate to put it on the net worth statement.
Love it, love it, love it. Nothing to add to that. That was a great question, Jay Butters. All right, this next one is from Robbie, and this is going to be one of those where I'm going to ask you, be like, but why are you asking that question?
Oh, no.
So I'm going to preface it, and I'm going to put some emphasis in the right places. Robbie said, what's the proper withdrawal strategy when retirement is reached? If you have an employer Roth 401k, employer pre-tax 401k, and a non-retirement investment account. So I've got these different tax buckets. What is the proper withdrawal strategy when we get to retirement? And the reason that obviously I keep saying the is because there isn't a specific absolute proper withdrawal strategy because it is very much based on your unique circumstances, like how old you are, what other sources of income you have, where your income is going to come from, what your spouse has going on in terms of age and income and resources. It is not one size fits all when it comes to retirement distributions. Just like when you were building your wealth, I'm willing to bet that if you just sit two people next to each other, some of them might have built wealth in a pre-tax 401k, and one of them might have had employer incentives and ESPP and RSUs, and another one might have had some real estate, and this person might have had an inheritance. Just like your accumulation journey is very, very unique to your specific situation, so too should your decumulation journey be. So there's not a specific proper withdrawal strategy. Now, having said that, here's some general advice and guidance to kind of think about. We really like you having those three distinct tax buckets that you noted. You have your Roth, your tax-free assets. Those are the assets that when you pull money out, you don't pay any income tax at all. It's completely tax-free. Well, then you have your pre-tax assets. These are pre-tax 401k contributions, IRA contributions, employer matching contributions. Those, when you go to pull them out, you got to pay ordinary income tax at both the federal and the state level. And if you still have those assets, when you get to age 72, the government makes you start pulling them out. They're subject to required minimum distributions. And then you have this third bucket, this after-tax or post-tax bucket that you can get to at any point in time. And it's taxed not at ordinary income tax rates, but capital gains rates as it grows. Well, the reason that we want you to have these three different distinct buckets is it's going to allow you opportunities in retirement to pull money from the buckets that you need as you need it. For two completely different clients with the same exact wealth level, let's say they both have $1 million in total portfolio value, and they have the exact same account structure across the three different accounts. It may make sense for one of them to begin drawing money out of their IRAs first and converting that to Roth and doing a Roth conversion strategy and pulling the rest in their taxable account. For that same other person, if they have a lot of pension income or they're old enough that they're drawing Social Security, Roth conversions might not make sense for them anymore. They might want to leave that money to be tax deferred until they get to RMD age. Even though they're the exact same situation in terms of assets, the distribution strategy is very, very different. Anything you want to throw on to that?
Well, I just like throw some analogies out there.
Okay.
You know, look, parents tell you they don't have favorite children, but they have favorite children. And just like you have your different account structures, and you went through the 3 buckets, Bo. You said tax-free Roth.
Yep.
You said after-tax brokerage accounts,
Yep.
and then you said pre-tax, which is going to be your employer match plus whatever you put in those traditional retirement accounts. If you're looking at those 3 buckets and treat them as their children, your favorite is going to be the Roth because it
Most
grows
likely, yep.
tax-free. It's going to be your favorite. So that's why when we talk about the financial order of operations, the FOO, we really prioritize outside of free money from your employer. We want you getting that money in that tax-free bucket.
That's right.
So what I find interesting is you're trying to get it in there, prioritize getting it in there, but you're also, it's like Gollum on Lord of the Rings, is that it's also going to be the one that you, my precious, don't let go of the easiest, because tax-free is such a powerful benefit. So more than likely, when you first retire, you're balancing between that after-tax brokerage and the traditional pre-tax assets on where you're living off of in retirement. In addition to, hopefully you have pensions or Social Security, and that's the balance. But here's what's crazy to me, and this is the planning opportunity that I love, and this is when I know we are earning our keep, is that favored child of tax-free growth is so powerful that we're also watching tax rates to figure out how do we get to turn some of that traditional pre-tax bucket into the Roth. And that's where you're talking about the Roth conversion strategies. It's really powerful stuff, but there's a bunch of minefields. You always have to be careful. I mean, I was just on a call last week, and the client asked me about this because they're quickly approaching retirement, and they're in their early 60s. And I said, well, here's all the things we have to take into account. I was like, look, you're going to retire before Medicare. So we know we have to pay attention to where are the subsidies on the Affordable Care Act when you are buying off of the exchange, because we're going to need that for 5 years before you get Medicare. We need to watch where your income so you don't go off that cliff, because if you go dollar over, it just disappears unless we're under the CARES Act. There's some weird stuff going on because of the pandemic. But that's something you plan. And then once you get over 65, you have to worry about Medicare premiums because your income goes up. That's impacted. It's taxability of Social Security. There's all these things. This is why, guys, I love all the discussions I see out there on YouTube in the comment section where it's cute that you guys think all we do is manage asset allocations and you can just
plug in the portfolio.
Just go buy the Vanguard index fund. Why should you hire these guys? I just chuckle to myself because I go, oh, just wait. Because complexity comes to you automatically with success. That's the brilliance of the abundance cycle, is that a good financial planner, yes, investments are a big part of it, but it's only one part of it. There's going to be a lot of other things that come around. And this stuff, like I said, making wealth is actually quite simple, but it can get really complex when you start having success. And that's why this is the type of stuff that we get excited about. We love helping our clients work through. So keep on saying, hey, I'm just going to buy the Vanguard index fund. You'll reach a level of success at some point that there's bonus level stages that will help you through.
So one of the things I think that does make sense is if you are approaching retirement, you are saying, hey, I want to make sure I'm doing this right in terms of my distribution strategy and all these things you said I need to think about. There's nothing wrong with getting a second opinion, reaching out to a really good advisor to help you try to navigate that. So if you find yourself asking those questions and you aren't exactly sure of the things that you don't know and you don't feel comfortable just with the advice that we're giving kind of here, laying out the education, reach out to a professional advisor and they can maybe help you navigate that. All right, this next question is from Will. Will says, hey, I'm married. That's awesome, Will.
I don't know if he had that inflection with his question.
Hey!
All right, let's hear
married.
the rest of the question.
Do we max out the second Roth IRA or do we invest in other areas like real estate? All right, so I'm thinking through this. Can I see your little cheat sheet right now?
You want the tax one or
I want
the
FOO
FOO
one.
They're both laminated, which gets me excited.
So if you go out to our website, moneyguide.com/resources, you can get this free deliverable that walks you through the financial order of operations. 9 steps, tried and true manual of what to do with your next dollar. Well, I'm going to make some assumptions here, Will, that you said do we max out the second Roth? Well, what that tells me is that you have your deductibles covered. You've gotten your maximum employer match for both you and your spouse. You don't have any high interest debt that you're working through,
You've already filled up your emergency reserves, whether that be 3 to 6 months of emergency living expenses. And now you are on to step number 5, Roth or HSA. And the question is...
Wait a minute, because I think this is great. But now I hear Will. I can already hear Will's voice. So I got the Roth. I want real estate. When do I get to real estate?
Exactly. So,
but I see some additional steps
here. Yeah, that's
here.
right. So I'm going to assume that you are square in step 5. And I would make the argument that, like, our recommendation is not in step 5, hey, just touch that bucket. You know, just $20 a month in my Roth. No, we want you to take advantage of all of the tax-free saving opportunities available to you, like Roth IRAs for you, like Roth IRAs for your spouse, and like health savings accounts for you and or your spouse and or the family, depending on your health insurance. Well, then, even after step 5, you got to go to step 6, and then there's step 7, which is where I would argue that real estate comes in if you're thinking about investing in real estate. So my answer to you would be that if you were still in step 5, it makes sense to finish step 5 before we continue on to step 7, because I think real estate comes in step 7.
Well, I think, but this is one of those things. I don't want you guys to think that we're that parent that does corporal punishment, and you say, well, why did you just spank me? and the reason is because I told you so. No, that is horrible. We need to give you the why on why this is the guidance we give you. Why would real estate fall to step 7 of the financial order operations? It's because, look, real estate's actually glorious in the fact, because you know what the whole secret on why real estate makes people so much money? It's leverage growth, meaning that you've got an asset that might be appreciating at 3 to 20%, but your mortgage is on, you put debt on 80% of it, so you're actually getting a much bigger rate of return because it's levered debt. So that's why people love real estate, is because it's big impact as long as you can make the payments. Here's the downside to real estate. And by the way, we're real estate people too.
Absolutely.
But here's the downside. Every now and then, it gets horrible.
Yep.
Because, the economy goes down. Because remember, bad news travels in packs. It's just not like volatility says, hey, I'm a loner, I'm going to hang out here. So when you see stock market volatility, it's only going to be stock market volatility. No, he's popular. He's got a whole posse that hangs out with him. And it's usually the real estate market goes down at the same time. Unemployment spikes up.
All happens
you see
at once.
all these things happen at the same time. And that's why you better be deeper in the pockets with your real estate investments to weather those storms, because levered debt is great on the upside. It's horrible on the downside, because you're making not only you're having to cover the expenses of it. You're having to make the mortgage payment. If you're doing this 5 and 6 and 10-fold, meaning you have multiple properties, you can quickly see how without income coming in, it could crush you.
Devastating.
So that's why we have it as step 7, is you have to have, we love real estate, but you better check the boxes and have a deep enough pocket that you can weather those storms, because that's what's going to break you. And that's where people, look, real estate a lot of times is made on the purchase. Do you know how you get awesome deals on real estate? You buy it from people who were not prepared when it goes through those market downturns, so that you're able to come in there, pick up the pieces.
You had a place way in much younger years. You did. I mean, you bought a piece of real estate, vacation. You and a bunch of other accounting buddies, and that was the thing. It was an opportunity thing. The price was there and available. That was how you were able to capitalize on that, right?
But then it got crushed, in the 2007 and 2008 downturn. And look, we made it through that recovery, but it was just complex. And here's the other thing. I'll tell you, I don't mind sharing what kind of blew up my real estate partnership with this vacation property was, first of all, I was sad that we never got to use it because it's too valuable during peak seasons. But the other thing is when you're in business with other people, if somebody gets divorced or something, it all blows up things. It gets complicated. So that's why I'm just saying step 7, so you can make it through all that complexity, as well as have the liquidity and resources. So no matter what comes your way, you're not going to get caught. As Warren Buffett talks about, essentially skinny dipping out in the ocean. The tide goes out, and everybody's going to see that you're naked, and you go broke.
Love it. Don't want to be broke and naked. 2 places you don't want to be. Number 8. This question is from Ryan. Ryan says, hey, money guys. I see that the Roth/HSA is step 5 of the FOO. What is an HSA? And have I made a huge mistake in not contributing a single penny?
I'm actually surprised when I ask friends, because this happens, never fails. In November, I'll have a handful of friends that reach out like, hey, my company's changing health insurance, and they told me I got this thing. What is this?
Yeah.
For me, I take for granted the fact that it's just wired in me. I know what HSA means. But Ryan here said, hey, I've never even heard of this. What is this thing? Why does it make sense, and why should I do it?
Yeah, it's a health savings account. Now, realize we love health savings accounts because they're what's called triple tax advantage. And what I mean by that is these are accounts that not only do you get a tax deduction when you fund them, they grow tax deferred, just like your retirement plans do.
Yep.
But if you use them for medical expenses, here's number 3 coming, you actually get to take withdrawals tax-free. So that's why triple tax advantage.
I love it. It's like a Roth IRA on the back end and like a pre-tax 401k on the front end. It's kind of exciting.
There's a big asterisk next to the health savings account. You have to be an actual member or a participant of a high deductible health plan, meaning that you essentially know that you are bearing the expenses of most of your health care, because the cost of the deductibles are really high, the out-of-pockets are really high. So you have to have this type of health insurance. So Ryan, I have to take it that if you've never heard of this, what that probably means is that you work at an employer that has what they call Cadillac insurance, meaning you have traditional health insurance where you still are paying, you go to the doctor and you just do a copay. Your deductible's really low. If you have that type of coverage, you just don't have the option to save into a health savings account. And then I always talk to people, look, you might have a cafeteria plan where you get choices.
Sure.
You might have a health savings account. You might have traditional. Every year when you go to re-enrollment, you're going to have to figure out which health insurance is best for you. And it might vary based upon your stage of life.
Absolutely.
I mean, look, you're young and healthy and you don't go to the doctor because you don't need to. Everything's working out for you. You're thinking, I'm a no-brainer. I'm going to just do the health savings account because, that's a high deductible, but I get to do the HSA.
Don't go any at all. Yep.
But what if you're having children? I mean, because that's an expense. So you need to take into account all these different things. But that is a health savings account is attached to your health insurance. It's a great opportunity if you are a lot of self-employed people or people who work for small businesses, like here at Abound Wealth. We offer health insurance to our employees, but it is a high deductible health plan because that is kind of the way you make health insurance affordable to everyone, is that you have to kind of have a higher deductible, but you offset that with that great health savings account.
Absolutely. It's a great thing. So you ought to go check, write to your employer, write HR. Hey, do we have access to a high deductible health plan? It's a really easy question to ask. Matt asked, he said, I'm not in a rush to buy a home. I'm just stockpiling cash for a down payment. Is it worth it to wait until a crash in housing prices before I buy, or is it better to just get into the market ASAP? Should I wait, or should I go ahead and get on team appreciating real estate, and how do I approach that? And maybe is there something the Money Guy team tells me that might help me make that decision a little bit easier?
So first of all, Matt, we have a treat for you. This Friday, we have a premiere on a real estate show, and it's going to be the housing market's in a bubble. Should I buy? Should I rent? Should I sell? We're going to answer all the questions because we're going to do this by age. So it's going to help people in their 20s, 30s, 40s, 50s, and beyond. So I would definitely tell Matt to tune in to our premiere that's coming up this Friday. But let me tease it a little bit. Here's something we found out in our research. This is a unique time. There's always some analysis going on. Is it a good time to rent? Is it a good time to buy? The separation between rent payments versus making mortgage payments, actually, right now, it favors being a renter. But I will look, there's a lot of benefits to owning a house and being on team appreciating real estate because, as you know, if like in our market right here in Franklin and Nashville, it's not uncommon for houses to appreciate 20%. So Matt's down payment might actually be running away from him, It's kind of like that cruel joke when your friends, they're all in the car already, and you go to grab the handle to get in the back seat with them, and they pull it forward, and then you're like, okay, that's funny, guys. And then you go up and they pull forward again. And you're like, seriously, guys. I mean, I want to get in the back seat. This was funny the first 3 times. I feel like that's what's going on with real estate and down payments for first-time buyers. But here's a cautionary thing with this. You better make sure, because I do believe that it's just like stock market investing is walking up a mountain with a yo-yo. Real estate investing in the long term can very much be the same way, but it's just that the higher real estate prices are going, it's the longer you better stay in that house to make sure you're not buying at the tippity top of the market and you're going to be there long enough to smooth it out.
You hit, Brian, on exactly where I was going to go with my answer. It's really, really difficult because the housing real estate market does appear to be very hot now. When it comes to making a home decision, I hope that it's a long-term decision, meaning that when you buy that house, you're planning on being there at least 5 to 7 years, but hopefully 7, 10, 15 years. So what that means is that when you do make the purchase, even if you do make it at the top of the market in 2007, right before a pending downturn, hopefully you're in the house long enough that you can recover from that you can make that up, that you can get that equity back. I would not let the housing market drive your housing decision so much as you let your life circumstance drive that housing decision. Because we've had to do that in my past. When my wife and I were growing our family and stuff, we kind of, even though we had moved to a new area and we kind of liked this whole renting thing, we had sold our house in Georgia and we're renting here, and it kind of felt wonderful. As our family began to grow, she said in no uncertain terms, hey, it's time for us to be in a house. We need a home. We're not just going to be bouncing around. And so we made that decision, and it was much more based on our life circumstance than where the real estate market was. So I think you got to really, that's one of those, there's a reason that a house is a use asset and not an investment asset. How you think about purchasing and utilizing use assets is very different than how you think about purchasing and utilizing investment assets. So I would measure that.
And you're hoping that use asset turns into assets that help you, but until you actually liquidate, it's not really, it's a use asset.
That's exactly right. This is one, Brian, we get all the time. Normally I try to ask you questions I know the answer to. I don't exactly know the answer to this one because I think this is a hard one, but you have some really good insight. This is from Alex. Alex says, hey, how do I find a good CPA for taxes? What are some good questions to ask? Or what's a good way to go about this process? I can tell you we've had sort of a mixed interaction with folks who are trying to move from being self-preparers to moving to a professional preparer. Some folks love it, and they say, you know what? I used to get my shoebox and I'd go through this and I'd spend a whole weekend, and now I can just take my shoebox and deliver it to the professional, and it's wonderful. And then we have this other line of folks who think, okay, well, I did that. Well, I still had my shoebox. I still spent the weekend, still did the same amount of work, and I came up with the exact same answer that the professional preparer came up with. I think there's a common misconception that professional tax preparers know some secret, right? Know something that is not available out there to you. And I think there's a common misconception that just because someone is a tax preparer, that means that they are a good tax preparer. So how do you think about, should I hire a professional? And if I do hire a professional, well, how do I know if I'm working with someone good? What are some questions are there times of the year that it might make sense for me to have the interview process that might set me up for more success than others?
Yeah, we're quickly coming to a close to this extended tax season because May 17th is the new filing deadline for individuals. I do think that this process should start probably right after the last, we're about to make it through May 17th. Good time to probably find next year's CPA or tax preparer. Might be in June or July when they're not just pulling their hair out trying to get returns out the door. But here's the kind of the decision matrix I would go to. Is if you're interviewing tax preparers, is you're trying to figure out what type of tax preparer they are and what type of tax preparer you actually need. Because there's a lot of you guys might be self-preparers and you're doing really good work. A lot of you financial mutants, we've had clients that we recommended go get you a CPA to do it. And then we find out you're still doing the taxes in the background.
You're not really saving yourself.
Christy knows who she is. But it's one of those things where if you're going to do that, I don't know if that's ideal. So ask yourself, are you really letting your hands off the reins?
That's right.
Assuming you are, you then have to say, okay, do I want somebody who's just going to prepare, get me through compliance by actually getting the forms done? I know I've done all the heavy lifting. I've answered, I have everything in this shoebox that I need to prepare taxes. There's no other way to save money. Then you can go to what I call just the kind of pay and go tax preparers. They're in the shopping centers. They're in all the, it's the household names of you show up, you sit there while they prepare your taxes, and then they have visuals and hear in my head, the dot matrix printers running their taxes. And they're all using laser.
I don't think they're using dot matrix.
Or sending you a disc. But
right
anyway,
now, Raby's looking like,
they're
what's
doing
dot
your taxes
matrix mean?
on the spot, billing you, filing. It's all done in one setting. Well, that's one type of prepare, and that's and by the way, that's not necessarily cheap.
Sure.
So what I'm amazed when I was doing tax preparation, everybody thought that grocery store or that shopping center preparer was the cheapest way, and I guess in some ways it is, but I think they were shocked to find out that a CPA sometimes might not be too much more expensive. So price shop this a little bit, because if you want more, that's where a professional like CPA or a tax preparer comes in. And here's what I think you're looking for when you have a professional tax preparer. Are they asking me questions to maximize the legal tax avoidance?
That's right.
Because they're trying to uncover what type of planning opportunities there are from a tax perspective, because that's what I was always trying to do. When I was preparing taxes for those 16 years, I personally was trying to pay for my fee by finding you additional tax savings. And I would, some of the big credits that were so easy is if you had dependent care credit, because nobody thinks about that. But if both spouses are working and you got a youngster that's in daycare or something, you're like, hey, how about that one? Where are you at with your charitable giving? Let's make sure that, we've documented everything with that. Hey, are we making sure on the front of the tax return, like in a unique year like this, that you maximize that? There was always ways that I was asking questions about, hey, talk to me about hobbies, talk to me about side hustles. What are ways that you're using your income so that I could go through a questionnaire, or I could go through an understanding of their financial life and help them maximize the opportunity. That might cost a little bit more, but if you can get the benefit of additional lower taxes or structuring your income in the most efficient way possible, I think it's worthwhile.
I agree. I'm actually gonna bolt on another question on this one because it ties in really well. Because this question, the very next question came from Hillary, and she said, if I'm using a financial service like Abound Wealth, right? So like financial planner, investment advisory type service, does that cover general tax advice, or would someone be wise to have a separate CPA and investment advisor service? Like, are there ways that those two can work together, or are they completely separate?
Well, they can. I mean, there are firms out there that actually have tax preparation. I mean, I don't mind sharing. Carter came in here like 3 weeks ago to me and Bo, because he's our chief operations officer, and he's third in command here at Abound Wealth. He's like, I think we ought to start doing taxes. It's like, Carter, what are you doing? No, we're not doing this. We had a big talk about it, because here's why we don't do taxes. Is I worked in tax preparation for a long time. Everybody can make a mistake in taxes. The tax code is so complex that everybody's going to make a mistake. And I value our relationship with our clients so much that I would hate to lose a long-term client over just a knuckleheaded decision or a knucklehead keystroke mistake on a tax return. So it's a big concern out there. But I like the separation, because I always think about, man, isn't it nice if you have multiple inputs into this plan? So what I like about what we do here at Abound is that we all of our primary advisors, because they're under our tutelage, they become tax experts too. I am so nerdy with taxes that everybody here kind of becomes an expert. We buy all the latest and greatest softwares to upload your tax returns into. We analyze it. We're doing the exact same mentality I had when I was preparing taxes. We're trying to find you tax deductions or mistakes to pay for our fee.
Absolutely.
I mean, we have totally taken this to the next level. But what I love is it also allows us to collaborate with your professional tax preparer so that they can not look at us as we're an adversary, we're trying to steal the business. No, we are a person that's here to add value, to help you quarterback, to help you. Maybe there's a communication breakdown with this client, this tax client you've had for years, and they just don't understand this concept. We have a way to help build a bridge there, and I love that collaboration. I remember the good old days. This is where I sound like an old man. Back when CPAs were not trying to be financial planners, insurance agents weren't trying to become financial planners, and estate attorneys were not trying to become financial planners. Everybody could kind of collaborate with each other. So we could all be really good. The financial planner was the quarterback of the situation, but all the other position players were experts in what they were trying to help you with, and you guys could all collaborate and figure out how we could create the best plan possible. That's not as easy to do now that everybody thinks they're generalist, and the life insurance agents now trying to push out their mutual funds and their investment shares, and then you got the estate attorneys and the CPAs trying to get in the game. They became more of a sales function instead of an expert, and I like when everybody can be really good at their position play, let the good financial planners sit on top of it and quarterback the situation. It's a win-win for everyone involved.
Love it, love it, love it. All right, here's a question. This is from Isaac, and this is an exciting one because we love small businesses. Isaac said, "My wife started a new business this year. Do you recommend solo 401k or SEP IRA?" So she's got a new business. They want to implement a retirement plan. Which one would we recommend and why?
Well, look, this is a great question. These things, it's always like the choose your own adventure. It all depends upon who's actually involved in the process. Without a doubt, if you laid down the two retirement plans and said which one's the best by features and opportunities, the solo 401k is superior to a SEP IRA.
I agree.
I mean, it just is. I mean, there's just a lot of opportunities because not only does the employer get to make a contribution, but you as both, because remember, when you own a business, there's two ways you make money: as the owner of the company, but also your work inside of the company. So you get to make salary deferrals to the retirement plan, just like an employee would. So that's a double thing. The employer's giving money as well as you, the employer, contributing to your retirement. There's a problem with solo 401ks, though. You have to have the premonition, the ability to plan, to know, what I'm going to have so much profit this year that it makes sense for me to maximize both the employer and the employee contribution. So if you have a successful side hustle, that's a no-brainer. But a lot of small businesses, especially, he said it was his wife's first year in business, money in is actually hanging out there on a tree. That money tree might be planted in the backyard with this side hustle, but it ain't generating fruit yet. You're like, I don't know. I mean, because even my own journey into being an entrepreneur, it took like 3 years to get my income up. So money's not guaranteed right after you start a side hustle. It might be more of a retrospective activity where when you're getting your taxes done, you go, wow, we actually made 15 grand this first year. So wouldn't it be nice if we could contribute?
There's a tax bill.
Yeah, there's a tax bill here. So that's because the SEP IRA does allow you, without even the DeLorean reaching 88 miles per hour, you can go back in time and open a SEP IRA for a previous tax year all the way up until the extended due date if you extended your tax return. Solo 401ks, you have to make the election before the tax year closed out. So I would tell people if you're on the edge, you don't know if it's going to be profitable, you don't know if you have a lot of money laying around, SEP is the easiest. If you are successful and have money and you want to plan ahead and you know there's going to be enough profit, enough cash to put in the salary deferrals, solo 401k all day long.
All right, I would go with a few tripwires just to make sure that you stay aware of. If you happen to be a higher income family and you are doing Roth conversion strategy every year as a means to build Roth assets, and you decide to open up a SEP IRA for your wife to fund,
good point.
That SEP now comes into the pro rata calculation for the Backdoor Roth. So it could impede your ability to do Backdoor Roths. That does not happen with a solo 401k. Well, with a solo 401k, one of the beautiful things that makes solo 401k so much better than traditional 401ks is they're super easy to set up, and there's no annual required tax filings. You don't have to file a Form 5500 every year unless The assets cross over $250,000. Once you have over $250,000 in your solo 401k, then you have to start filing an annual Form 5500. It's not hard. There are no taxes due. It's not complicated, but it is something that you must do, and you will get a really nasty letter if you fail to file that Form 5500. So just make sure that you keep an eye on as that solo 401k is growing, as the account is getting bigger. You don't want to forget to file that. And then the third thing, if this is your wife's side gig, right, and she has another job, maybe she has a full-time job that she does,
great
and
point.
she has access to a 401k already that she's participating in. There's nothing that says that she can't also do the solo 401k. However, she is limited to one $19,500 salary deferral contribution in total. So it's okay. She might do $10,000 to her current 401k and $19,500 to her other 401k, but you don't get to do $19,500 to both. So you want to make sure, again, that you don't trip over that wire and accidentally overfund a solo 401k without taking into account what she has available in her other job if she has a normal daytime job.
This once again reminds me, creating wealth is relatively simple.
Yep.
But you do this long enough, you have enough success. This is the abundance cycle. It will get complex. I mean, this is why I love it. Our job's not going away. I mean, that's why, go buy your Vanguard index funds, but at some point you will reach a level of success. You're going to need somebody to help you navigate all this success. Bo just went through the decision matrix that a good financial planner should help you be able to work through.
Guys, we love, love, love getting to these questions. Thank you so much for tuning in, being a part of this live stream. Frankly, we couldn't answer your questions if you didn't ask them. So thank you for participating. Thank you for allowing us to do this. If you've not had a chance to go check out the website, go to moneyguide.com. We have a resource page there, moneyguide.com/resources. Tons of free deliverables. You can get our financial order of operations deliverable, our tax deliverable, our mortgage refinance deliverable, our how powerful are your dollars deliverable. We have all kinds of free deliverables available for you out on the website. If you want to go even deeper, and you heard us talk about this financial order of operations thing, go check out our course. You can go to learn.moneyguide.com, see what the course is all about. But we thank you that you allow us to be on this journey with you.
Money Guy team, out. Every one of these cameras is like blinking away.